Welcome to today's video, and we're going to discuss the macro ICT scalping model that I've been using for the last 1.5 years. It's really easy to implement, really easy to use. We're going to talk about how to identify the model, where you're going to enter, how you're going to exit, risk management, all the good stuff. And if you're new here, guys, my name's Ruben. I've been training for roughly about 2 years. Just so you know too, right, this flowchart that I've got on the screen, this will be available in my free Discord. So join that, the link is in the description below. But without further ado, let's get straight into the video. I want to discuss the ICT macro scalping strategy and how it's made me profitable. Now, firstly, let's start with the basics, right? What is macro scalping? We need to define what ICT macros are, and then we can discuss the principle of scalping, risk management, trade management, all the rest of it. What are ICT macros? You need to understand this. So this is segment number 1, understanding what a macro is. Now to put simply, like it says here, right, the macro is a time window. It's a time element. So when ICT in the past has talked about price and time, this is the time element. And later on in this video, we'll talk about how we can combine the time, which is the macro, with price, which is the entry model. So the scalping model is simply combining the macro time, price, and putting the two together for a small scalp, a 1-to-1, a 1-to-1.5. And I've mentioned here that there's macros all day. So if you trade the Asian session, the first macro is going to be between 650 to 710. And if you trade the PM session, the last macro is 350 to 410. By the way, these macros occur in every session. So that's the first one. This here is the second one. And if you trade the London, like myself, or New York session, you might trade New York, it'll apply for that too. And that's all I've mentioned here, right? So if you trade the London session, this is a macro, this is a macro, this is a macro. And if you trade the New York session, if I just move this down, right, the 950 to 1010 is a macro, the 1050 to 1110, 1250 to, you could go on forever, right? There's so many macros across the whole day, but you have to understand this. Principle number 1 is that macros are a time window, and they exist 10 minutes before and 10 minutes after every single hour. Step number 2, what are you looking for? Like what are you looking for around that macro time frame? To put simply, and this is the best way to put it, you're looking for something important to happen. And later on in this video, we are going to define what this word means. What do I mean by important? And it's going to revolve around using inversion fair value gaps and low resistance liquidity. And we'll get through a few examples later in this video. Now, I want to point this out. A lot of people ask me, this is a really important point, jot this down, write this down. Yes, the macro could be from 950 to 1010, but I extend this 5 minutes before that and 5 minutes after. So if you're looking for entries using this model, you can extend it, right, from 945 to 1015. Because a lot of people say to me, Ruben, there was an entry at 946. I didn't take the trade. It wasn't in a macro. It's still using the macro framework. We'll talk about it. Let's also define this while we're here. So take all these notes. What do I define as important? What's important? What are we going to look for? What should you look for inside the macro period? Now, for me personally, I'm looking for a few things. And the entry model we're going to discuss today, very simple, very easy. It's going to be using an inversion fair value gap, or sometimes we're going to use a change in the state delivery or an order block. We can also look for this to happen. Write this down. Write those 3 words down. The macro to pivot. For example, if you're looking at a chart like this, say I was to draw this out, right? If you see the market do this, and we tap into a higher time frame key level, and this down here is the macro right here. I'm anticipating that the macro is going to reverse. The macro can pivot. And then all we're looking for in this segment of price is the inversion fair value gap paired with like a change in the state delivery. It's as simple as that, right? And I mentioned here that yes, some macros will perform better. However, there's nothing that I can say, look, if you hop into the charts every single day, this macro, there's going to be a winning trade. That's not how it works. Nothing is 100%. However, if we can line up with higher time frame price structure levels, we get a better chance of this model working. Now that's out of the way, let's get into a few examples. And I've broken this down into a flowchart. Right, but let's get into a few examples here to start. Now, this one here, if you have a look, this is from Monday, the 7th of April, right? And this is if you trade the New York session. We'll start with that. Now, I want you guys to have a look here at what's happened. And I've marked out 2 things. I've marked out the range high in blue and the range low here is in red. Price forms all this accumulation, comes down, manipulates. Would you agree that we are below the halfway point? So this is the high, this is the low. where price is in the macro, we're below the halfway point. We're in a level of discount. So in discount, we're looking for longs, and then we pair that with the idea of the macro. Have a look. We have a nice inversion fair value gap here. We enter from this candle, stop below the bodies, and we target either a 1-to-1 or a 1-to-1.5. It's as simple as that. We make sure we've got relative equal highs, in this case, accumulation to target. They're both the same thing. That's low resistance. That's good liquidity to target. And we ride it a 1-to-1. And if you want to hold a runner, you can hold a runner. But purely the scalping model is 1-to-1s, 1-to-1.25s, something of that nature. Moving on now to the London session. This is from earlier this week. This is the 8th, right? So you can have a look down the bottom here. I personally trade the London session with my Discord. Been a really good week this week. 8 wins and 3 losses, so really nice week in London session. And this illustrates the power of scalping. This macro down here, this is the 1250 to 110 macro. This is the 1150 to 1210 macro. Have a look at the charts. 1150 to 1210, midnight macro, 1250 to 110. Now, for those that are sitting here saying, well, that's not enough to take. In these situations, you're going to be stopped out. When you're scalping the market, you can capitalize on these smaller moves and still make money in a choppy market or in choppy conditions. And especially when the market's volatile, I would much rather in these conditions, with all the stuff going on with Trump, I would much rather take those small hits and then build it on from there. So this here, really easy. We come down, we invert this fair value gap, as you can see, right? We enter from there, we take a 1-to-1, call it a day. Over here, we've got a nice bearish candle. We invert that right here. That's our inversion gap. We enter somewhere up here. We take a 1-to-1, go to break even, happy days, we can move on. So these are 2 examples so far, one from the London session and one from the New York session. But just so you know, this will occur anytime. Even the Asian session, you can do it, right? Have a look here. Asian session, look at the bottom of the chart. This is from the 3rd of April. And if you have a look at the time there, it's 8:40. Now, what did we say? 5 before or 5 after is completely okay. So 8:40 is roughly here. If you enter somewhere from here, once we've created that inversion, we can take a 1-to-1, we're done. A lot of people are trying to aim for these highs. They're aiming for too much. And if you aim for too much and the markets are very choppy, you're going to get chopped out. You're going to get lots of break evens, lots of losses that don't need to be taken, in my opinion. So this is how the macro scalping model works. We're looking for the macro. We're looking for liquidity to target, ideally low resistance. We are ideally looking for price to be in premium or discount. Again, let's go back to that basic concept, the really important concept that ICT talks about. I'm going to draw it up on the screen here. If this is the high of the range and this is the low of the range, price can do this, right? If we're at the bottom portion, we're looking for longs. If we're at the top portion, we're looking for shorts. And we can see exactly the same thing here on the chart. Range high and range low. We are in the bottom portion, so we're looking for longs. Let's have a look here. Range high in blue, range low in red. We're in the bottom portion looking for longs. Upper portion looking for shorts. And notice how with scalping, you're going to get so many opportunities so you can pick which ones you like. That's the beautiful thing. There's not just going to be one set, there might be 2, there might be 3. And if you take a winning trade here, and you're done, that's it. If you take this winning trade, you're done. You're not trading anymore. The scalping model suggests and it states that, look, you take that 1-to-1, you're done, you lock yourself out of your account, you come back tomorrow. If you miss this, and maybe you trade later on in the silver bullet session, say, London session, for example, you can look at this here. And again, this is from the 8th, if you're looking. This is from the 8th if you want to go back and check it out. So we sweep the range high. Look at this. We sweep the range high. We form SMT at these highs. Really nice. And we form an inversion fair value gap. Look at the time down the bottom. Look at this time. That's 4 o'clock. There's a macro right here. 350 to 410. What does that macro do? It spools. What does that macro do? It pivots. And we talked about this at the very start of the day, that one function of macros is to pivot. So if we're coming down, we expect the macro to pivot back up. If we're going up, we expect the macro to pivot back down. And you pair that with a sweep of liquidity, you pair that with premium and discount, you pair that with all these other confirmations we're talking about, and you have a really easy to implement and a really solid model. This is all I use. All the payouts I've gotten have been from this macro model, not from the 2022 model, not from the unicorn model. They both work, but all from this model. And so many people are finding success using this because it's easy. It's easy to look at. You can see it, right? You can identify it very clearly, and you're not going to be in a trade for 2 hours waiting, hoping that it's going to move in your direction. You know very quickly, within 10 minutes, if you're going to be right or if you're going to be wrong. If we go back to this, this flow chart and even back to this point here, this is how we're going to do it. This is how we're going to build a model. And I hope today's been insightful about what we can look for. So to put simply, how do you start scalping the macros? How do you start doing this? How? Well, number one, revise this information. Go back, watch this video, take notes. Take notes, save the video, download it, do what you got to do. Determine what session you're going to trade, right? So for me, with the premium Discord, I go live 4 days a week, Monday to Thursday. For me, it's London session with those guys and girls, and it's also Asian session. For you, it could be PM session. For you, it could be New York session, could be London, whatever it is. It works in all sessions. Once you've made that decision, if the answer is yes, then we can move up here. And again, this is all going to be available for free in my free Discord. The link to that will be in the description below. And when you get in that Discord, just send me a message or tag me, say, hey mate, hey Ruben, I'm looking for this flow chart, and I'll send that through to you. So you've made your decision now. Identify areas where price can react. I'm going to give you a couple, right? I'm going to give you a couple. Number one, we've talked about higher time frame fair value gaps. And number two, we talked about using premium and discount. We talked about that, right? So if we're in discount, look for longs. I know the writing's a bit wonky. If we're in discount, look for longs. If we're in premium, look for shorts. And if you're in a higher time frame FEG, it's optimal to look for a big reversal. So we've got that, tick. Number two, identify liquidity that you're going to be able to trade towards. So for example, if you see the market, form a range high and a range low, the market does this. It's forming low resistance. We're at the bottom. There's a macro. That's the liquidity we're targeting. Ideally, I'll give you some hints. Low resistance liquidity, equal highs and equal lows. These are all the good things to target, right? Equal highs and equal lows. So you've got this, tick. Moving on, identify the inversion fair value gap that forms around the macro time frame. This one's pretty cruisy. The more impulse that creates the gap, the better. If it doesn't create the gap with impulse, this is important. If there's no impulse fair value gap or inversion, wait a little bit more and wait for an impulse candle, then enter off that. Tick. If all this criteria is met, then guess what? We take the trade and we're happy with any outcome. This model works. We take the trade. If it's a win, good. If it's a loss, good. All we have to do now is manage risk. And I'd recommend you guys, if you haven't already, check out my most recent video on YouTube. It's a 53-minute video. I talk about risk management of trades and how important that is. How important that is, right? You can reduce your average loser and end up very profitable even if you keep getting chopped out of the markets. Keep that in mind. All criteria are met? No. Well, if the criteria aren't met, you're not going to take the trade. And what needs to happen here is this. You need to go back to this point. You need to go back to the first point, right? Because these criteria being met are what makes this model the model, right? The macro scalping inversion fair value gap model. You can pair it with SMT. You can pair it with low resistance. You can pair it with all these other things that you've learned from ICT, premium discount, optimal trade entry, higher time frame fair value gaps. These are all important things that I personally use. But keep it simple. Keep it simple, right? And just two more examples before I conclude this video. This one here is from the New York session on the 3rd of April also, right? 3rd of April, you can see the times. I've marked the macros with these two vertical lines. Very, very simple. We come up, we sweep liquidity. We trade back down, back up, we form an inversion gap. Entry comes from here or entry comes from here. Stop goes above these bodies. You take a 1-to-1, you're done, you move on. Happy days. Next example is in the next macro. And sometimes you see this, right? Go back in your charts if you're still here and see how many times, again, the macro pivots. And I've made videos on this in the past, but the macro often will do this. It'll pivot like this, and then it'll pivot like this, and then it'll pivot like that. Next macro, you can't make it up, right? Again, this is the 1050 to 1110 macro. We go from bearish to bullish, and we have this really nice inversion gap created with impulse. Beautiful. Entry here, stop loss there, take a 1-to-1, you're done. Easy. Right, so this model is what I've been using for now over a year and a half, a year. It's made me profitable. It makes my approach to the markets, and it could make yours very simple because that's what it should be. You want to be able to implement something day in and day out and use other concepts to help you, right? Use SMT if you want, use premium and discount, use a sweep of liquidity to help you as well to phrase those trades, right? You need to have all those things checked off, right? All these things we talked about in this flow chart, you need those things. Identify areas where price can react, identify liquidity, identify the inversion fair value gap that forms, and if all criteria are met, you take the trade. If not, you go back to the drawing board, you wait, next macro, who cares? Be patient, right? Be patient. Become the observer in that situation. And last example here was from the 2nd of April, right? 2nd of April, and this is the 350 to 410 macro, right? And again, you can see the macro here does something important. The macro I'm trying to illustrate, again, goes from bearish, and then when do we reverse? During the macro. So if you're looking for a reversal and it's not happening for you, it's not happening. When is it going to reverse? When's it going to reverse? Just wait for the macro, and often that's when the reversal will take place. You can take earlier losses with proper risk management and come back to take advantage of that scalp. With that being said, guys, I hope this video has really helped you, right? This is my model. This is my strategy. This is what I do personally, what I teach in the Discord, on YouTube for free, everything. If you like this video, leave a like below. And again, if you want this flow chart, this whole thing, join the free Discord below. And I'll talk to you guys very soon. Have a great week, a great weekend. And I know with this volatility, it can be tricky. Just manage risk properly and you'll see success. Peace out.